We're trying to help people realize that succession isn't the end, right? It's a process.
At the end of the day, we want advisors to make the best choice for themselves. We want to continue to earn their loyalty throughout this process and the loyalty of their successors in the next generation.
They're looking at the succession plan. They know in this environment, they're gearing towards growth.
We help them realize that they don't have to do this in the shadows. There's resources there to help you see what you're really about to do before you do it.
Welcome to the Total Succession Show. I'm your host, Tyson Ray, joined by Kim Kokenauer. We're glad you're here. Subscribe at totalsuccession.com/podcast and let each episode guide you closer to a confident, well-planned exit. Today's conversation just might be the nudge you need to start preparing for what's next.
Welcome back to the Total Succession Show. If you're a financial advisor, chances are you've been hearing a lot about valuations lately. Practices are selling for multiples, sometimes 8 or 10 times or even more. And when you start to hear numbers like that, it's natural that you'd be curious, but like, what is my practice actually worth? But what those headlines rarely explain is how those deals are actually structured.
They lead with a big bullet point and a lot of zeros, and they hope you don't get into the details. And our whole point of Total Succession is to try and educate you on what is out there so you can understand what you're looking at, and more importantly, what you want to do with your practice and the clients that you are responsible for. And we're thrilled to have Emma on today to help us navigate some solutions that Raymond James has and also insights when it comes to succession.
Emma, welcome to the show. We're really glad to have you here today.
Thank you, Tyson. Thank you, Kim. It's an honor to be here. It's such a relevant topic right now and one that's so critical for advisors to get right. So I'm glad we're taking the time to have this conversation.
Today, we're going to unpack what's behind those valuation numbers. And we really thought Emma would be a phenomenal guest to have because she spends her time helping advisors think through succession and transition. So, Emma, before we really jump into the conversation, I'd love for you to give our listeners who don't know you background on you, your role today, and the kind of work you're doing to help advisors around succession.
Absolutely. So I lead our succession and capital platform at Raymond James, where we partner with advisors to help them monetize, grow, and eventually transition their practice in a way that aligns with their long-term goals. So my team builds capital structures that give advisors flexibility, whether that's investing in their growth, thinking about bringing in next-generation partners, or maybe they simply want to put some money in the bank as peace of mind. Whatever form that takes, we help do it in a way that protects their legacy, namely their teams and their clients.
That's huge.
Yes.
And I love the three aspects because, again, we're trying to help people realize that succession isn't the end, right? It's a process.
It's a journey.
And there's stages to it. And you need to be thinking about it instead of being surprised at the end. You have limited options or you wish you would have done things sooner.
Absolutely. Earlier planning comes with more optionality for advisors, for sure. And then just by way of background, I came to this work through corporate strategy at Raymond James for many years. And then prior to that was doing early stage equity investing. So my background's really been in understanding how partnerships and capital can be used to build, scale, and eventually transition businesses.
That's huge. Well, and I'm sure that comes in very handy when you're sitting across the table from advisors who have very strong personalities when it comes to what they think their practice is worth. So we're going to start there. So what are you seeing in those numbers in the market today?
Multiples have gone up for a while now. And just to kind of make sure everyone understands, I think to explain it, it's helpful to know why too. So for starters, the wealth management space is an attractive industry for investors. You've got high recurring revenue, strong margin with a lot of cash flow, sticky client assets. And so that's made it attractive for people to want to buy these businesses. And accordingly, there's been this influx of private equity capital into the wealth management space that's really made it more competitive for high quality practices. What's interesting there is that, if you look at the allocation of private equity dollars across a variety of different markets, wealth management has historically underpenetrated. But as private equity has gotten comfortable underwriting people-driven businesses, we've been playing catch-up now for the better part of the last decade with no signs of that slowing down whatsoever. So I'd say it is a seller's market. These multiples are here to stay. We see ranges quoted. It really, again, it comes down to, you got to unpack that headline valuation, but across the board, what's clear is that valuations have gone up and it's going to be here for a while.
Well, and I think that's a key topic that a lot of advisors are concerned about, and feeling some of that panic and urgency, like, oh, is my practice even going to be worth the same multiple like 2-3 years from now, 5 years from now? So I think providing that historical perspective that the wealth management space is trying to basically catch up from that standpoint gives them a little bit, maybe might give you listening an opportunity to kind of exhale and not feel like it's a fire sale on your life's work, that you actually do have some time. This isn't a flash in the pan moment for our industry.
Absolutely.
Yeah. And are you going to put your client's interests first, or are you going to put how much money you can make first? Because you really need to decide that before you go in, because without that stake in the ground, you can get misled to more money, but that may not be what is best for your clients or the culture your clients trusted their life savings to. And I applaud several advisors that I know that left money on the table as far as their succession went, because they wanted to do what was best for their clients and best for the team that helped grow the practice to be worth something in the first place. And again, part of total succession is just, we don't want to regret the decisions you make in the future when it comes to your succession. And so we're trying to offer some guidance, but we spend our entire career with put our client's interests first, and then unfortunately in the PE space, we then sell it for a multiple that will create a by definition conflict for either your team, the clients, or the services those clients are going to get.
Yeah, very true, Tyson. So Emma, one thing that I think kind of helps maybe you listening kind of understand when they're thinking about their practice and who might be out there as a buyer, there's lots of options when it comes to buyers in the marketplace. So we don't need to get into who's who, but I think because you've had a lot of these conversations with advisors and buyers in mind, what are some of the key characteristics that tend to drive value in the practice?
Yeah, great question, Kim. And I'd say we look across 4 dimensions when we're looking at a practice, and this tends to be pretty universal, I'd say, across the board. But those are durability, growth, the team, and their systems. So to unpack that a little bit further. So durability is kind of what you said, the recurring revenue. We're looking for stable businesses, high percentage fee base. We want to see that they can retain clients. They've got a well-diversified client base and with healthy margins so that they can withstand any business cycles. Mm-hmm. Secondly, the growth factor. If teams have a continued repeatable a plan to achieve net new assets, that's incredibly attractive. So that might look like new client acquisitions. That could be expanding your services. That could be deepening your current client relationships, whatever form it takes. That repeatable path on NNA is highly valuable. Third, the team. So what we're looking at here is understanding where a practice is and its growth and succession life cycle, and how much depth that team might have. So whether that's really excellent support staff, a strong COO, great next generation partners, a good succession plan, all of that plays into the overall valuation. Mm-hmm. And lastly, systems. So thinking about the infrastructure, the processes, how the business runs on the day-to-day. So the less key man risk there is, the more confidence we have that the value of the business over the long run is still going to be there.
Okay.
All of those, it's rare that we see a home run across all 4 dimensions. And it's why advisors have actually really been interested in our minority equity solution because we have a phenomenal equity partnerships benefits program where, depending on where advisors are today, we can have the opportunity to plug in resources from Raymond James to ensure that they're best in class across all these dimensions. But I'd say it's rare to get kind of an A+ across all those categories, unless they're listening to you guys and they're super focused on this topic all day and likely rightly thinking about it as a business strategy.
Well, thank you for that. I think it's good to consider that there's always areas for all of us in our practices to make some of those considerations or changes to make sure that, for even if you're not looking to sell, the strength and longevity of your practice can be wrapped up in all 4 of those categories and something to work for. Absolutely.
Well, and I think the advisors need to think about those 4 pillars because they could be really successful in just one of them and think that's enough. especially if they're really successful, it's them running the whole business and now they want to get out, but they didn't build the team or the systems or the growth that when they're not there anymore, it can continue. And so I love to help you listening to this realize that it's 4 different pillars. You don't have to be 100% in all of them, but you really do need to be starting to think about them.
Mhm.
So what are some pitfalls when they come to these contracts or deals that you see to try and help them see what they're missing?
Yes. Yeah. So 3 key questions that we always tell our advisors to unpack, because as you both are correct that valuation is really just a headline number. The first is, what is the consideration? So what is cash and what is equity? And if it's equity, how confident are you in that equity's liquidity as well as what it's actually worth? So, what we'll see is a lot of these dozens of new companies that have been stood up and are offering their equity. In order to monetize that portion of the package, you are dependent upon their future liquidity event. And it's always been like an IPO is 2 years away. It's kind of like free beer tomorrow. We've heard this for a long time now. But unfortunately, it's not been an attractive market. Then RIAs are lacking exits. And what's happened is, they don't want to go public because their valuation is going to drop. So there immediately goes enterprise value. Then they got to buy off their leverage, pay down the leverage to be a publicly traded company. And then you've got preferred partners getting their first distributions. And then what's left of this equity pool for advisors, you can see how it quickly goes down to zero, unfortunately. In best case scenarios, we've seen advisors kind of get pennies on the dollars when they wanted to leave, when that liquidity event, when they've got frustrated after many years and they haven't had an option. So the devil's in the detail there of understanding the operating agreements and understanding what's, that waterfall of distributions, what's north of you on the cap table and how things would get paid out.
So the point is for some of these equity deals that look like they're golden handcuffs, it ends up being fool's gold in some cases.
Correct. And even be worse sometimes if the way they make you buy in, if it's not, true rolling in equity, you could have a taxable event where you're paying taxes on the equity without even monetizing it. So definitely in partnership with your CPA and understanding your lawyer, understanding the contracts very well.
Understand phantom income before you have it.
Yes. Well said. Yeah. Our equity research groups put out a really interesting research report a few months ago, just walking through some of the math on RIA exits to illustrate this a little bit more tangibly. I know we're all finance-grounded people, so I think it's great to see that visual. So yeah, that's the first question is, what's the consideration? The second question is, what are the underlying terms to that consideration? So are there super aggressive clawbacks? Do you see really unattainable growth hurdles? Is market performance being backed out of those growth hurdles? You have to do the math based off of all of the fine print to figure out what you think is actually going to pay out. And sometimes we've heard from advisors that it's just been, especially with some of these growth hurdles, disincentivizing. They're so egregious that it has the opposite impact for them.
Or they're all of a sudden you're stressed out about growth and at the end of your career when you for decades never worried about growth. It just did the right thing for the client and it'll come.
Exactly. Like a second career or third career, fourth career that you weren't looking for to try and really put the pedal to the metal at that stage in life. And a third question being, and honestly, I think this is probably the most important and needs to be talked about the most upfront, is understanding the operating model you're stepping into. So we have seen with the proliferation of all these new firms, there's virtually every operating model out there under the sun, but they all seem to share the same simple, compelling narrative, which is a high valuation today, operational support, and the promise of scale. However, a lot of these have business models that force a significant shift or pivot away from an advisor's legacy strengths. And what we see that tends to be, as Tyson, a lot of what you were saying earlier, it's at the cost of, the client and the team experience. So as assets and the team is pushed into these efficiency-driven models, that client experience erodes. You see lack of direction and choice, especially after that initial transition period, after the honeymoon phase, then things get real. And you tend to see that the next generation leadership really loses their autonomy as they're forced into low base salaries and away from meaningful production roles. And all in, it's really the valuation at the end of the day is sacrificing an advisor's future optionality and their flexibility. So what we're trying to do is solve across all those dimensions, not just the financing, but make sure that the team and the clients are in great care.
So takeaway is that if you get a valuation and you're like, wow, you might a couple years later be saying, wow, for a whole different reason, because a lot's going to change.
Yeah.
And we've had colleagues that, their key operating folks for them almost always are the first to go. The people that ran the back office and the operation don't need them anymore. And they were somewhat surprised, and they tried to no, they were going to find another home for them in the firm, but that really didn't work because they were coming into your office every day. Two, I have another advisor that basically his entire team, he chose, it ended up letting his entire team go the way that operating model was working. And then we've had other clients show up at our door that all of a sudden the advisor retired, had his earnout, probably still holding on to the equity, but that they got rolled up to effectively, and this was a multi-million-dollar account, got rolled up to effectively a 800 number with it, right? With I think an associate that had, I couldn't get back to you in the last 3 days because I have 600 households I'm taking care of. And is that really the best advisor? It's just an interesting model that our businesses before PE showed up still had some wonderful valuations, and they're worth more now. But again, the more you stretch for more money, the more suffering or change you are going to experience, your team may experience, or the clients may experience.
Yeah. We've seen multi-generational family businesses just experience that. And especially when it's that family component, it's really tragic to see what I believe is the American dream and the hard sweat equity and work that you've put in decades of building what's so rare and so unique to still have. To be able to preserve that is something that's truly special and that we're really looking to do.
Yeah. Emma, I'd love for you to kind of speak into some of the challenges advisors were running into, which is what ultimately led the team at Raymond James to kind of find this path for succession. So I'd love for you to kind of talk a little bit about the impetus for this and what you guys saw as the opportunity in the workspace.
Yeah, absolutely. So we have very low regrettable attrition as a firm, and we pride ourselves on it. And quite frankly, for a few years with the shift of dynamics, we started to see that trick up just a little bit. And we spent a ton of time working with the advisors that were facing these problems and advisors that had left us. And I'd say it boiled down to two problems that we were trying to solve. So the first is that it's virtually impossible for practices to cash flow at some market competitive valuation now without some form of a capital infusion. So we needed to come up with some equity solution for our advisors. And secondly, as we're all so well aware, somewhere between 30 to 50% of advisors expect to retire in the next decade, and each of them have varying levels of successor readiness or capabilities or lack thereof. So needing help and guidance around all of the succession components, not just the financing pieces, but how they structure it. So we're really trying to, what we've built is us being a partner to solve this financing need in a way that's flexible for the advisors and gives them all of the guidance that they need as their practice evolves over the next 5, 10, 15 years. I'd say what we learned, though, from working with advisors and what we saw in the competitive landscape was really that what was out there is that we can be doing something better that's more aligned to our core values of advisor independence and advisor choice and long-term orientation that works much stronger for our advisors.
Yeah, that's huge.
Yeah, and I feel like that's where in some period of time in the future, because these businesses are being valued that they don't cash flow the valuation, so it's an equity play for a portion of it. And if that equity doesn't show up, it's fake money on the original terms of the deal.
Yeah.
And it reminds me of economists that I heard back in the financial crisis, before financial crisis happened, that said, and it was a British economist that said, you Americans didn't learn your lesson from the 80s that real estate needs to cash flow its valuations, or at some point there'll be a correction. Either the cash flow has to increase or the valuation's coming down. And given our cash flow in the business and fee per compression, and those types of things, clients living off their portfolios more than just letting them grow for decades. Yeah, I don't think it's going to be the cash flow side or the margin side that's going to improve dramatically. So either at some point we have to grow new assets, or these equity valuations may surprise us later.
Right. Yeah, and I think to take the full circle, Tyson, that's really where what are the exit opportunities for these aggregators, and where there still remains a big question mark in the industry. So I love your analogy there. I think it's a good lesson.
Yeah, it's at some point, someone's got to pay for this.
Yeah. Yeah. Gotta pay the piper
Or a
eventually.
third, yeah, or a third of your deal is a lottery ticket you may not collect on.
Mhm.
Correct.
Yeah, absolutely. So, Emma, help us understand. So, what is the approach Raymond James has taken to help support advisors going through succession?
We've expanded our financing menu. We've always done debt financing. We'll still continue to support advisors there. We now have new equity solutions where we'll either make a minority stake up to a 30% investment in advisor's practice or a full acquisition. So it's now this robust financing menu that we can pull from these different pieces to create a bespoke custom package for our advisors. The minority piece dovetails really nicely with the debt piece. So the concept here is we would buy up to 30% of the practice, then lend financing to the other partners to purchase the remaining 70%. An advisor can maintain fully independent throughout that process. They have full operational control. That we heard that loud and clear from our advisors. They love their independence, and we want them to maintain that independence. Who better than advisors to know how to run their business? We do not know what's best for your P&L and what's best for your team, what's best for your clients. So that is, again, when we talk about doubling down on legacy strengths of our advisors, that's how we see that playing out. And then the full acquisition model is really for teams that either don't have yet an identified successor, or their successors prefer to focus on client service as opposed to business ownership. So we'll onboard them to the employee channel. They can offload a lot of their business owner responsibilities, and we'll help them through that transition with more resources from the firm.
Yeah. And are you seeing, when you're meeting with advisors, are you seeing more of they don't have the successor wanting to take on the practice and they're coming in the employee channel? Or are you seeing more of them wanting to take some of the equity off the table and deal with the debt part, and then they can self-finance and run the business themselves? What's your percentage on that?
The first thing they wanted from us was the minority solution.
Mm-hmm.
And so that's where we first launched in May of last year. And it's been met with tremendous success. We've had more demand than we've had capacities to support. So the majority of our independent advisors want to stay independent. And again, I think what's great is they're thinking about this ahead of the time. So we've had advisors that are doing it for growth. When they're taking the minority investment, the remainder of their plan to share might not happen for another 5 years. So there's no shot clock that starts with any of this. We're now an equity partner and doubly invested in their success. So we come to the table with a lot more resources to make sure they're thinking about this holistically and helping them through that transition.
That's good to know.
So in the minority side of things, is it specific to each advisor that comes to you, or is it, like everything else in some of these other minority deals, that the language is such they might as well be a majority? There is no divorce agreement that without the approval of the minority shareholder. How has Raymond James solution approached that situation?
Yes. So what you touched on, I think, is one of your earlier questions, Tyson, I didn't fully answer to, but about pitfalls. It comes down to the operating agreement that unfortunately people might not see until you've already been building a relationship, and then you get stuck with something that's a surprise that it's a 120-page document. We are very transparent from the beginning about everything, but set this up in a way where advisors can maintain full operational control. We do not involve ourselves at all in any of the day-to-day operations. So the advisors own their P&L. They're involved in their own hiring and firing decisions. Again, we will help facilitate. We do all of the legal documentation, the entity setup, so we can take that weight off the financial advisor's back, and advise and consult for all of that. And then another piece you touched on, Tyson, that's so important are the exits, and making sure, again, what we saw out there were either vague, if at all, if they existed, because they purposefully, it is forever equity and you're never going to get it back. It was clear for us from the beginning that we needed simple and clear exit terms for advisors. That's part of our structure.
If someone was listening to this and they're in the RJ system, and because I'm in the RJ system, we have a lot of folks that are part of the RJ family plugging in, and they're getting solicitations, or maybe they've gotten down the road of exploring some of these other offers that are out there of all the different versions thereof. Is your department a department they can come to you and basically, can you help me understand this? And what does Raymond James do? Like, can we help them realize that they don't have to do this in the shadows? Like, there's resources there to help you see what you're really about to do before you do it?
Absolutely. We're mindful of any NDAs advisors have signed, and our advisors honor those as well, very well. But we consult to make sure that they understand and are asking the right questions. Starts with what their goals are. So all of this is about alignment, and maybe for some they do want immediately the highest valuation, guaranteed cash out. It's better to understand what your goals and your objectives are, and then you can figure out what the best model is out there to meet it. Now, what we're building, we have a ton of flexibility, and we'll say that we can match any of those, but with a trusted partner, which is in our minds and in the eyes of our advisors, incredibly valuable.
Absolutely.
But you're definitely right. It's a consultative process, and at the end of the day, we want advisors to make the best choice for themselves, and that's why we built ours with such flexibility. It's not handcuffs. It's not something that they're making a decision that like we've seen with some others that unfortunately they might regret. But we want to continue to earn their loyalty throughout this process and the loyalty of their successors in the next generation.
Yeah. Well, and that's huge because especially when there's massive amounts of money on the table and that future legacy in mind, that it's nice knowing that they're available. Your team and the team at Raymond James is available to help answer those questions and help them think through some of those things, even if you don't have any essential skin in the game, if you're not even taking a minority share in their company. So, our listeners are very geared towards growth. They're looking at the succession plan, whether it's 5-10 years down from the line, but they know in this environment they're gearing towards growth. So can you help explain a little bit more how your team and the team at Raymond James is helping them with the growth factor and the potential minority ownership?
Yeah, we thought our number one use case would be more around succession planning. Now, we've had a ton of advisors that we've seen are early in their career doing phenomenal growing, and maybe they only want to sell 10% instead of 30%, depending on what their growth rates look like. But they've really been interested in the minority deal for all the growth partnership, as well as some of the peace of mind and tax efficiencies that it does bring. So our equity partnership benefits program is really just a way of us saying, we are doubly invested in your success now, and we put together a whole platform that we see as evolving over time. This is what it looks like today, but we expect as the firm's resources and our capabilities, especially with AI and with cyber and everything we're doing to build the firm holistically, that partnership benefit program is definitely going to change as our company grows. But it's everything from we can do quarterly strategic meetings with our team, with their divisional leadership, rotating subject matter experts based off of whatever an advisor's goals are that they're trying to accomplish. We've got phenomenal training from, early stage, maybe their next generation needs some to go through our AMP program, resources across marketing, all different business solutions. We've, pair planning resources. We're in the process of rolling out a virtual CFO. All of these resources are there and at the ready, and we will co-invest alongside the advisor in whatever capacity of whichever they're interested in to make sure that they've got the support that they need to hit the next milestones.
Wow. So touching basically every element of their business with that level of support, I think is what I took away from that. That's pretty impressive.
Yes, there's a lot of options to choose from. So it's really just starting with what do you need, and we can do it. Yeah.
Build from there. So, Emma, one of the things I think that would be helpful to kind of understand, we talk a lot about to advisors and those listening, succession planning is starting a lot later than it should for a lot of people. It's eliminating a lot of their choice. And so I know that this is kind of brought to the forefront to help advisors not feel some of that panic, right? But I'd love for you to kind of just have a chance to speak to advisors out there. When should they really start thinking about their succession if they want to have the most options available to them? What's your advice?
Yeah, yesterday. And does everyone hate that answer, right? Like, no, what a cop out.
It's a good answer, Emma.
Oh, yeah, the old adage of when to plant a tree. But it's true because just, successful succession outcomes take years to plan for. And that is because you are cultivating relationships, you're building people, you're putting in place systems and structures that, when done well, it takes thoughtful, deliberate time to do that over a period of years. And As we've said, if the advisor starts planning earlier, they can be more selective about who they bring in, how they can refine those structures, more selective and thinking about doing it gradually. And so you want to have to compress this into some tight rush timeline. But really, I think succession, it's not an end of career decision that you're making, but rather it's a business strategy. And when it's done thoughtfully and well, that really adds a tremendous amount of enterprise value and builds strength for a practice well before any transition ever happens.
Yeah, that's key. That's key. And I don't think that's the wrong answer. That's the right answer. I think we're trying to help light a fire for those of you listening who haven't done anything yet. If you didn't start yesterday, today is a great day to kind of start taking those steps. So, Emma, for anyone who's listening who is not part of the Raymond James network, but they kind of they're intrigued. They're like, I don't think my custodian or the broker dealer I am in relationship with or custodian, they have these resources. Where should they go to find some more information, since this might be more of a unique lane for Raymond James to carry?
Yeah, absolutely. I would strongly encourage you to get in touch with a recruiter today. They can help get you in touch with the right team and share more, continue the conversation about how we think about long-term partnership, growth, and succession. And if advisors are with Raymond James, encourage them to look on RJNet under Succession and Capital. We have a ton of resources and ways to get in contact with our team to start the conversation today.
That's great. Tyson, what would you like to leave our listeners with today?
Well, if you're feeling overwhelmed by listening to this, I want to take you back to what I hit on earlier and Emma hit on just recently is just what do you want? And realize that I think the highlight of this conversation is that maybe it's not an all or nothing, like jump out of the airplane, pull the ripcord. Maybe it's partnership, and maybe it's taking a few bites at the apple by letting pieces of the company go to give you some capital, to take some risk off the table, to think about opportunities where it's not this one and done, you're closing, you're sold your firm, or you've married somebody, and who knows what that marital agreement says. And so that's why I was just so excited to have Emma on, because it's like when I first was hearing about the solution, how the structure goes and the resources, it's like, more people need to know this is out there. So I'm thrilled to have Emma on and just help you realize it's listening to this. Stay plugged in, take the book, reach out to Emma, follow up on the resources we put on here, but keep informing yourself and start acting on what you're learning to put your plan in motion.
Well said. Yeah, an excellent note to end on. And it was really just a pleasure to be on here and to see you both again today. It's always a great time chatting with you.
Yes, Emma, thank you so much for joining us today. And remember, everybody listening, there is a goal for you to create the space for you to intentionally think about your future. So like Tyson and Emma said, you have to find a place that you want to get started and what you're trying to get to. So make time today. So we'll be back soon with more conversations like this. And the views and opinions expressed on this podcast are those of the speakers and do not necessarily reflect the views of Raymond James or its affiliates. This podcast is provided for informational purposes only and should not be construed as investment, legal, or tax advice. Listeners should consult their own financial, legal, or tax professionals regarding their individual circumstances. Total Succession and the Total Succession Show are not affiliated with Raymond James, and Raymond James does not sponsor, endorse, or guarantee the content of this podcast.
These conversations are designed to support your next move, however close or far it may be. Tap subscribe and let each episode guide you closer to a confident, well-planned exit. I've wrestled with these things myself, and that's exactly why I created something to help you do it with less stress and more direction. My book, Total Succession, is now available on Amazon. Inside, I break the process down into 5 clear steps to help you exit on your terms with confidence, full compensation, and your client's best interests at heart. You can also visit totalsuccession.com/podcast to download a free starter guide that walks you through my SPACE framework: see, prepare, act, commit, exit. Remember, you only exit your business once. Create the space to do it well. Thanks for listening. Until next time.